Welcome to the Ultimate Beginner's Guide to Moving Averages. In this course, you are going to learn what moving averages are all about from the ground up, the advantages, disadvantages, techniques, strategies, properties, MA types, secrets, and more. Make sure to watch the whole video before reaching any conclusions about how to trade using moving averages. The goal here is to open the hood and explore the good and bad sides of one of the most famous technical indicators of all time. If you're new to the channel, make sure you check out the Ultimate Beginner's Guide playlist also. Without further ado, let's begin by taking a look at the definition of moving averages. To understand what a moving average really is, we need two ideas: the idea of mean or average and the idea of rolling calculation window. The concept of average is known by most people, but let's quickly review it. Let's take a simple example. If we have three hypothetical closing prices, and we want to calculate the average, we sum all closing prices and divide the result by the total number of closing prices, which is 3 in this case. This average we just calculated is called arithmetic mean, but there are other types of means that are used in the calculation of moving averages, like the geometric mean and the harmonic mean, for example. The other idea you need in order to grasp the concept of a moving average is the rolling calculation window. This is best understood with an example. Let's say you have a series of hypothetical prices. Let's now say that we are going to calculate the mean of 4 numbers at a time, starting on the left. In this case, we'll get 21. In other words, the number 21 is the average of the last 4 numbers in the series. Now we move one number to the right on the series and calculate the average again. This time we get 23. Notice that a no number got out of the calculation and a new number got in. The green box is the rolling calculation window. This is analogous to the period of a moving average. For example, when a trader says that he's going to use a 20-period moving average, he's going to use a setting that calculates the average of the last 20 closing prices. The rolling calculation window property of moving averages never changes, but the way to calculate the mean or average does change. When we say that there are different types of moving averages, we refer to different ways of calculating the mean. This moving average we have been calculating so far is the well-known simple moving average, or SMA for short. The main characteristic of the SMA is that all values inside the rolling calculation window have the same weight in the calculation, meaning that they equally affect the final result. If we use a graph to represent the way values are weighted in the simple moving average, we'll get something like this. Consider that each of these bars represent one value in the calculation of an SMA. The x-axis represents the values in the series, and the y-axis represents the weight or importance that each value has in the calculation. Notice that all bars have the same height. That means that in an SMA, the oldest value of the rolling calculation window is as important as the newest value. However, if we think about this for a moment, we'll see that the SMA doesn't make much sense. In a price chart, the newest values are more important than the oldest values, so we should choose different weights for them in the rolling calculation window, meaning greater weights for newer values and lesser weights for older values. That's where the idea of the exponential moving average came from. If we look at the weight profile of an exponential moving average, we'll see something like this. The weights decay exponentially as we look back to older values. In other words, the new values receive a lot of weight, while old values receive considerably less weight. This makes the EMA react more quickly to price changes than the SMA, because while the SMA is giving equal weight to all values in the rolling calculation period, the EMA is giving more importance to the recent values. In this chart, we can see a reflection of that. The black line is a 20-period SMA, and the red line is a 20-period EMA. Notice how the EMA reacts a little more quickly to price changes because of the exponential decay in the weight profile. By saying that the EMA reacts sooner, I mean that it changes direction before the SMA. Beyond the SMA and the EMA, you'll find a host of different moving averages with different weight profiles. For example, we have a linear weighted moving average, which has a weight profile that follows the shape of a linear function. We also have the triangular weighted moving average, which weight profile resembles the shape of a triangle. This moving average, for example, is less sensitive to something called drop-off effect, which we'll discuss later on. So far, we have considered the calculation of moving averages using the closing prices, which is the common choice, but there are other possibilities. In fact, there are 3 parameters we can change in the moving average. The first one is called length, which is the size of the rolling calculation window, also known as the period. The second parameter is the source, which is the type of values that are going to be used in the calculation, like closing prices, for example. The third parameter we can change in the moving average is the offset, which shifts the whole moving average forward or backward in time. Let's begin first by talking about the length, which is also known as the period of a moving average. This parameter controls how large the rolling calculation window is. Different lengths will produce different results in the final calculation. For example, small lengths will cause the moving average to react more quickly to price changes, while larger lengths will cause the moving average to react more slowly to price changes. MAs with short lengths react quicker because they have a lower number of values being averaged. For example, in this chart, the black MA has a period of 10 and the red MA has a period of 50. Notice how the fast black MA follows price more closely, while the slow red MA is less sensitive to price movements. Given that situation, it might seem obvious to choose an MA with a short length, but there is a catch. Even though the black MA is faster, it has more noise. The red MA is slower, but it has the advantage of being smoother. This is known as the lag-noise trade-off, which we'll discuss later on, and is one of the major flaws of technical indicators that use averages. In summary, a small length will produce an MA that reacts quickly to price and it has poor smoothness. A large length will produce an MA that reacts slowly to price and has a good level of smoothness. The second parameter we can change in a moving average is the source of calculation, meaning the type of value that is going to be used in the moving average calculation. The most common source for moving averages is the closing price, but we can use open, high, low, or a few combinations of the 4 prices, like high plus low divided by 2, high plus low plus close divided by 3, high plus low plus open plus close divided by 4, or high plus low plus close divided by 4. These are different sources of calculation with different motives. For example, some traders believe that the high plus low plus open plus close divided by 4 better reflects what's happening in the market rather than just the close. In this chart, you can see 2 SMAs. The red MA has closing prices as a source, and the black MA has open plus high plus low plus close divided by 4 as a source. Notice that there is almost no difference between the two, so there is not much point worrying about different sources of calculation that involve a combination of open, high, low, and close values. When we use individual prices like just the high or just the low as the source, however, the difference becomes significant. For instance, in this chart we can see the black moving average using highs as the source and the red moving average using the lows as the source. This creates a moving channel that can sometimes be used as some sort of support and resistance band. Another interesting possibility is to use other data streams as a source other than the 4 prices. For example, we can use one moving average as a source for another moving average. In this chart, we have a black SMA using closing prices. The red SMA uses the black SMA as a source, so we are basically calculating the moving average of a moving average. This has the effect of smoothing the original black SMA at the expense of adding even more lag to the signal. Notice how the red line is smoother and takes a lot longer to change direction in comparison to the black line. We can also plot moving averages on other indicators. In this chart, we can see a moving average plotted on the RSI. To do this, plot the MA in the chart, then drag it down to the RSI window, and then change the MA source to RSI. You can also use the built-in moving average that is available in some indicators. The third parameter we can change in the moving average is the offset. The offset controls how the MA will be shifted in time. Generally speaking, traders use an offset of 0, which means that the current MA value will be plotted in the current candle. An offset of +1 will shift the MA 1 period into the future, and an offset of -1 will shift the MA one period into the past, for example. In this chart, we have three different MAs of the same type and the same length with the same source, but with slightly different offsets. The black MA has an offset of 0, meaning that the last value is plotted on the current bar marked by the vertical line. The blue MA has an offset of positive 1, meaning that it is shifted one bar into the future. And the red MA has an offset of -1, meaning that it's shifted one bar into the past. The original goal of a moving average is to filter the apparently meaningless noise of price and show the implicit direction of price. In other words, the moving average is a smoothing filter. Treating raw price action as meaningless noise is a move in the opposite direction of what traders should do. However, that's a different discussion that requires other types of courses. For the time being, you should know that the original goal of a moving average is to filter out the noise and see the direction that prices are headed. Do moving averages reach their original goal? The answer is yes, but there's a big catch. A moving average indeed filters out the noise in price action, but it does that at the expense of adding lag to its signal. So even though it filters price and shows a smooth change in direction, it does that when it's too late. In summary, a moving average is effective at removing noise, but it is ineffective at showing changes in market direction in a timely manner because of lag. This is one of the big problems with MAs. So let's explore this flaw and others in greater detail. By far, one of the biggest problems in a moving average is called lag-noise trade-off. The greater the level of smoothing in a moving average, the greater the lag. In other words, the more efficient a moving average is at showing smooth changes in market direction, the less efficient it is at showing these changes with good timing. Another way of seeing this is that if you decrease noise, you increase lag, hence the name lag-noise trade-off. All smoothing filters have lag. It's a law. That happens because there are past periods being used to calculate the current period, and that will always add lag to the moving average signal. There is an enormous effort to find a moving average that reduces lag while maintaining smoothness. There are some tricks you can do in order to reach that to some degree, but there are still other issues in moving averages that make them extremely unreliable. We'll talk about these tricks later. In this chart, we have three MAs. The black one is a 5-period SMA. The blue one is an SMA that uses the black one as a source, and the red one is an SMA that uses the blue one as a source. In other words, we are progressively smoothing the signal to observe the lag-noise trade-off. Notice how the black SMA has some noise built in. It changes direction abruptly sometimes. The first time we smooth the signal, which results in the blue SMA, we can already see a significant decrease in the noise, which results in a significant increase in lag. Observe how much longer the blue SMA takes to change direction in relation to the black SMA. By smoothing the blue SMA, we get the red SMA, which is extremely smooth and also extremely lagging. The lag-noise trade-off renders moving averages as ineffective if the goal is to show the underlying direction of price with good timing. Another flaw of moving averages is called drop-off effect, which is when a significant old value goes out the rolling calculation window, causing a change in the current value. This is better understood with a visual example. Notice in this chart that we have a 4-period SMA. Notice the large bullish bar in the middle of the chart. When that bar goes out of the rolling calculation period, there is a break in the moving average value. In other words, a past event distorting the current calculation. This effect is less pronounced in moving average types that give more weight to newer values like the EMA, for example. This is a problem because if a trader is going to use a moving average to see the underlying price direction, the last thing he wants is an abrupt change caused by past events. The trader wants a line that is as smooth as possible and with the least amount of lag at the same time. One of the worst problems of moving averages is the lack of adaptability. Moving averages are non-adaptive because they have a fixed rolling calculation window, while the highs and lows in price change size and time duration. Notice that sometimes MAs are incredibly capable of showing accurate and smooth reversals in a timely manner, and other times they are worse than terrible, showing buy signals when you should be selling and selling signals when you should be buying. That happens because highs and lows differ in size and time duration, while moving averages have a fixed window of calculation. In this chart, we can see a 50-period SMA. Notice how even the simplistic SMA is capable of showing a smooth trend change in this case. The red arrow shows where the SMA changes direction to the downside, anticipating a large movement down. In this case, the 50-period SMA is in sync with the relative size of highs and lows. However, when the relative size of highs and lows change, the 50-period SMA goes out of sync with price, and it becomes the worst technical indicator available to show smooth and timely changes in market direction, as you can see in this chart. The problem is that it's impossible to know when the size of highs and lows will change, and how they will change. It's precisely this lack of adaptability that makes moving averages work sometimes and fail miserably in others. Let's see another example. Here's a 10-period whole moving average. As you can see, this MA period is incredibly effective at capturing price reversals when the time distance between a high and low is roughly 13 bars. However, when you have smaller highs and lows, the moving average will produce false signals, as you can see in this other chart. The lack of adaptability of moving averages means that they cannot predict when and how highs and lows will change size and time duration. In other words, a moving average is a linear solution to a non-linear problem. It's simply the wrong tool for the job. Another flaw of not only moving averages, but many other famous technical indicators is called self-fulfilling prophecy effect, which is when indicators work not because they make sense, but because they are famous. This property emerges precisely from the fact that a lot of people believe and act as if such indicators are good. A self-fulfilling prophecy is when something becomes true because people behave as if this thing is true, even if this thing is not true at all. Imagine, for example, that all of a sudden, a significant proportion of the market participants start to believe that price will always rise on Wednesdays. Obviously, this doesn't make any sense. There is no strong connection between the day of the week and price rising or falling. However, if a lot of people start to behave as if this is true, price will indeed rise on Wednesdays because traders will start buying on Wednesdays. The reason for that is the supply and demand logic of the markets. If people believe price will rise, they will start buying, meaning that demand will increase. If demand increases, sellers have the motivation to sell at increasingly higher prices. Supply and demand will reflect what market participants believe, not necessarily what makes sense. If people start believing nonsense, price will reflect that. Even though this proposition that price will always rise on Wednesdays doesn't make any sense, if enough people start to believe it, it will become true in the market. That's a weird property of complex systems like the financial markets, where a prediction about the system alters the system itself. That's not true in other complex systems like the weather, for example. A prediction about the weather doesn't change the weather. In the financial markets, something very similar happens with famous technical indicators like moving averages. Moving averages are perhaps the most famous and most used technical indicator, and so there are many traders who believe they work. The fact that too many people believe they work in such a way makes the moving averages actually work once in a while. For instance, if too many people believe that a 20-period SMA will work as support or resistance level for price, when these people see price reaching the SMA, they will react as if this property of MAs is true. The result is that sometimes the MAs work as expected, and then traders start to believe that such a thing cannot be a coincidence. Notice that the fact that MAs work sometimes has nothing to do with their capacity of explaining what's happening in the chart. It's a mere effect of too many people believing them. Even so, retail technical traders are not the strongest forces in the market, so MAs will only work when there is nothing else more important happening in the markets. For example, a moving average will not be able to hold price as a support or resistance if there is major macroeconomic news happening in the opposite direction. The macroeconomic force is infinitely greater than the force generated by retail traders believing the power of moving averages, for example. Notice also that the science behind a technical tool is one thing, and its power to generate the self-fulfilling prophecy effect is another completely. One trading tool can have absolutely no science behind it, and yet if too many people believe it at the same time, it becomes true in specific moments. Once again, this might seem like an advantage, but it's not. Good trading tools need to have a solid scientific backbone. The self-fulfilling prophecy effect is merely a flaw of supply and demand in combination with the spread of information about how technical indicators are supposedly accurate. Out of the four main flaws of moving averages, we can do something about the lag-noise trade-off and the drop-off effect. Trying to solve the lack of adaptability is a ridiculously difficult problem, and there is nothing we can do about the self-fulfilling prophecy effect other than being aware that it exists. As far as the lag-noise trade-off goes, there is a tremendous effort to find a mathematical formula that reduces the lag of an MA at the same time that a sufficient level of smoothness is preserved. Out of all moving averages I have seen so far, the one that does a good job at that, even though it's far from perfect, is called whole moving average. You can find a detailed explanation of how the HMA is calculated on Alan Hull's website if you're interested. In this chart, we can see a comparison of a 20-period SMA in red and a 20-period HMA in black. Notice how the HMA has a significant decrease in lag while having a smoother line than the SMA. Even though the HMA is far superior to the SMA, it still has lag and it still has the adaptability problem. In other words, the 20-period HMA will only capture a certain size and time duration of highs and lows. And once again, we cannot know when the size and time duration of highs and lows will change and how much they will change. That's the issue of using a linear solution to a nonlinear problem. There are adaptive indicators out there, but they are more sophisticated versions of linear indicators only. One trick you can employ to reduce the lag of a moving average even further is to calculate its rate of change. The rate of change is analogous to the idea of the derivative in differential calculus. The rate of change of a moving average simply calculates the acceleration of the MA line, or how fast it's rising or falling. This is better understood with a practical example. In this chart, we have a 20-period HMA plotted on the chart. Notice how there is lag in the way the HMA changes direction. Now let's plot the rate of change of this HMA. We do this by changing the source of the rate of change indicator to use the HMA series. Initially, with a period of 10, the rate of change yields roughly the same timing as the HMA, but if we reduce the period or length of the rate of change indicator, therefore increasing its sensitivity, we'll see how the indicator will remove some of the lag of the original HMA while preserving most of its smoothness. This looks amazing, but it has its caveats as well. The rate of change indicator will produce false signals where the original HMA will not, because it's more sensitive than the HMA. Beyond that, we still have the problem of lack of adaptability in the rate of change indicator. Remember that we're trying to apply a linear solution to a nonlinear problem, which is always going to generate a dramatically imperfect result. If you plot these two indicators on your charts, you see that they will fail a lot of the time. Either way, the rate of change is one of the best ways of reducing lag in lagging indicators in a simple way. Let's now move on to moving average trading techniques and strategies. Keep in mind that I'm simply showing both the advantages and disadvantages of each technique. I'm not endorsing any of them. The goal here is to learn the limitations of this tool so you don't waste your time. The first technique is the one we have been talking about so far, which is to trade according to the change in direction of the moving average. When the moving average is going down and then turns up, there is a buy signal. When the moving average is going up and then it turns down, there is a sell signal. The advantage of this technique is that it's extremely simple to use. There is no need for deliberation as it is perfectly objective. That's the only advantage. When it comes to disadvantages though, the list is a bit longer. The first disadvantage is that there is quite a bit of lag in moving averages, so entries will always be imprecise. Another disadvantage is that the moving average period that works in strong trending markets will fail miserably in sideways markets and vice versa. The problem here is that we cannot really know when trends will turn into sideways markets or when sideways markets will turn into trends. That basically means that the money you will make in strong trending markets will be given back to the market in sideways scenarios. That will put you in a relentless roller coaster where you believe that you have a winning system only to find out later that the system was terrible. Once again, the problem here is the lack of adaptability of moving averages or any linear indicator for that matter. Let me show you what I mean with simple charts. Here you can see a 40-period HMA showing very good buy and sell signals. Just a simple change in direction of this moving average will give you extremely good results in this scenario. In this other chart, you can see the rest of the story. This period for this HMA would fail in this sort of market scenario. The buy signals appear where you should be selling, and the sell signals appear where you should be buying, roughly speaking. Those profits you would have made in the last chart would all be destroyed in this chart. In conclusion, don't waste your time with a simple linear solution like this one. The next common technique we're going to analyze is the price cross. This is also extremely simple. The buy signal happens when price closes above the moving average, and the sell signal happens when price closes below the moving average. Once again, the only advantage of this technique is that anyone can apply it because of its simplicity. You can take a person who has never heard of trading and teach her how to do this in less than an hour. Not surprisingly, the disadvantages are exactly the same as the previous technique. We have the lag, the fact that MA periods that work for trends will not work for sideways markets and vice versa, the fact that the money you will make in one market scenario will be given back in other market scenarios, and the lack of adaptability issue. Let's observe the situation in simple charts once again. Here we have the daily chart of Bitcoin with a 50-period SMA. By using the price cross technique, you would have produced a 393% return in a matter of 190 days. By looking at this, you might be convinced that the 50-period SMA is the way to go. However, in this next chart, you can see the other side of reality. In many other types of market scenarios, this MA period will produce false signals. Once again, the point here is that we cannot know which MA period is optimal for the current and future market scenarios. No matter how much you attempt to optimize the MA parameters, the basic premise of the strategy is flawed, so don't waste your time with this one either. The next technique we're going to analyze is the famous moving average crossover, which involves two moving averages, one with a fast period and one with a slow period. As you might be expecting already, the advantages and disadvantages are exactly the same as the previous two techniques. The moving average crossover is very simple to use, but it has a tremendous amount of lag. It works on one type of market scenario while failing in others, and a terrible level of adaptability. The most famous MA crossover system is called Golden Cross and Death Cross, which involves the 50-period SMA as the fast average and the 200-period SMA as the slow average. The Golden Cross happens when the 50-period MA crosses above the 200-period MA, and the Death Cross happens when the 50-period MA crosses below the 200-period MA. In this chart, we can see that this system generated almost 60% of gain in the 1-hour chart of Amazon. Once again, you have the impression that this is good. However, right next to this scenario, we have this one. The money you would have made in the last chart would be given back to the market in this one. The same problem emerges. In conclusion, don't waste your time with moving average crossover systems. No matter how much you tweak them, the lack of adaptability problem remains a constant. The next technique we're going to talk about is slightly better than the ones we have been analyzing so far, and it's about using moving averages as dynamic support and resistance lines. MAs will act as support when price is above them, and as resistance when price is below them. The advantage of this technique is that it's simple to use, and unlike the other techniques, it has no lag. In other words, it's a way to use a lagging indicator without the lagging element. As far as disadvantages go, this technique is a little bit different. Since we are removing the lagging element of moving averages, we don't really have the lack of adaptability issue. However, there are some problems with it. The main issue is that this technique in isolation is not enough to build a system or strategy. The other issue is the self-fulfilling prophecy effect. This will only work when there is nothing else more important happening in the market. One trick you can use here is to wait and see if price is going to respect the moving average when it reaches it. If price touches the MA and produces some sort of reaction, there is a better chance that price will bounce off of it. This is the self-fulfilling prophecy effect being used in your advantage. For example, in this chart we have a 40-period SMA. Notice how price touches the SMA as resistance in the first red arrow, then produces a larger upper shadow in the candlestick. That's an indication that price will indeed respect the SMA as resistance. Beyond that, the SMA is able to act as a barrier for price in the next 3 red arrows. In a situation like this, you can enter a short trade with caution, if and only if you have a safe place to put a stop loss order and if your risk-reward ratio is higher than 1 to 3. The stop could be above the high of the candle that first encountered the MA, for example. There are many other instances, however, where price will simply ignore the moving average, as you can see in the price action contained in the rectangle of this chart. This is why you need to wait for a reaction in price if you're going to use this strategy, and you'll need a stop loss and a solid risk-reward ratio. Do not attempt to scalp the market by trying to catch the initial bump of a moving average. That's a terrible idea. By the way, if you want to learn more about the dangers of scalping, watch the Ultimate Beginner's Guide to Scalping in the video card. This is perhaps one of the best things you can do with a moving average, but if you want to build a strategy, you'll need more than this. So if you want to use this technique, use it with caution or combine it with other techniques as long as they don't have the lagging element. The last technique we're going to analyze is the fractal crossover, which is a slightly better technique using the concept of fractal analysis. You can see fractals as patterns that repeat inside themselves. By applying this idea to the idea of moving average crossover, we get interesting effects. To visualize this strategy, we'll need multiple time frames. In this strategy, we have the pre-signal and the signal. As the name suggests, the pre-signal is a preparation for the actual buy or sell signal. We'll use 2 HMAs. The fast period will be 10 and the slow period will be 20. But remember that any combination of periods or lengths will produce good and bad signals. The buy pre-signal happens when the fast MA crosses above the slow MA on a high time frame. The sell pre-signal happens when the fast HMA crosses below the slow HMA in a high time frame. Once we have the pre-signal, we must jump down to a lower time frame to scan for the buy or sell signals. The buy and sell signals are exactly the same as the buy and sell pre-signals, but they happen in the lower time frame after the pre-signal is confirmed in the higher time frame. In this daily chart, you can see an example of sell pre-signal. The vertical lines show where the pre-signal is confirmed and where it ends. Once we have the confirmation of the pre-signal in the daily time frame, we go to the 4-hour charts to scan for sell signals. Notice that once we have a sell pre-signal, we will only take sell signals and we're going to filter out the buy signals in the lower time frame. Inside the crossover found in the daily time frame, we have 7 sell signals, most of which would have been successful. One stop loss rule you can use is that the stop loss is going to be above the highest high over the last 10 candles. That will usually capture the last significant high before the crossover that generated the sell signal. For buy signals, you would use a stop loss below the lowest low over the last 10 candles. The risk-reward ratio must be between 1 to 3 and 1 to 4. This strategy uses the higher time frame to create some sort of momentum pressure to sustain the crossover signals in the lower time frame. If you insist in using a crossover strategy, this is much better than the single time frame crossovers. Even though this is better than the single time frame crossovers, this strategy also has its bad moments. The strategy will generate many false signals when the higher time frames generate crossovers that have a short time duration, like we can see in this image. In the example I gave, I used the daily and 4-hour charts. This works in the exact same way in all time frames. The advantage of this strategy is that it's less terrible than the single time frame crossover, and it's still very simple to use. The disadvantage is that it's still not enough to form a sound trading strategy. The silver lining here is that this is a prelude or a gateway for you to get into fractal market analysis, which goes much deeper than this. In summary, you can play around with this strategy, but you need to be cautious. This is far from enough to produce consistent results in the long term. There are many other strategies involving moving averages, but this is just a beginner's guide, so we'll only cover the most relevant. It's time to wrap things up and talk about some conclusions we can achieve regarding moving averages. Moving averages are technical indicators that have many flaws. They have tremendous amounts of lag, and they don't fulfill the purpose they were meant to fulfill in the first place, which is to show the underlying market direction without distracting market noise in a timely manner. The element that produces bad timing in moving averages is precisely the element that smooths out the noise. This unfortunate property is the lag noise trade-off, which we covered in the course. Moving averages also have other terrible flaws like the drop-off effect and the self-fulfilling prophecy effect, which makes traders believe that the entire market will respect moving averages, while in reality, there are many other stronger forces acting on price. For instance, macroeconomic vectors or news events will annihilate any sort of support and resistance created by moving averages. Another fatal flaw of moving averages and many other technical indicators is the lack of adaptability, meaning that they are linear tools being applied to a non-linear system. In other words, fixed rolling calculation windows being applied to a non-linear highs and lows in terms of size and time duration, not exactly the appropriate tool for the job. With all of that said, there are ways of using linear tools in a non-linear way, as we have seen in this course. However, if we are going to worry about this problem of nonlinearity of price, there are much better alternatives than moving averages. Hopefully, you are able to learn the advantages and disadvantages of one of the most famous technical indicators of all time. If you wish to learn more for free, please check out the Ultimate Beginner's Guide playlist in the YouTube card. I also have a playlist showing technical indicator secrets. You can also search this channel for more advanced trading ideas. If you wish to learn all the things you need in order to trade, check out my paid courses in the links available in the video description. If you made this far in the video and you like the material I produce, please don't forget to like the video, subscribe to the channel, activate the notifications button, share the video with your trading community, and leave your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.